Imagine interest rates fall, and your corporate bond still loses money. That can happen. Treasury yields may decline while credit spreads surge, overwhelming the benefit. In this lecture, we uncover the forces hidden inside a bond's yield and use yield curves, duration, convexity, and credit analysis to see which bonds are most exposed before the market moves. Bonds may look simple at first. A bond promises cash flows in the future, usually coupon payments along the way and principal repayment at maturity. But the value of those promised cash flows can change every day. Why? Because the market changes the rate it uses to discount those cash flows. Investors may also change the extra return they require for credit risk, liquidity risk, and uncertainty. The central idea is this. A bond price is the present value of future cash flows. When the required return changes, the present value changes. When investors become more worried about the issuer, the present value may also change. When the bond moves closer to maturity, the cash flow pattern changes as well. In this lecture, we will focus mainly on fixed-rate, option-free bonds. That gives us the cleanest setting to understand the core concepts. By the end, you should be able to explain why bond prices move, how yield curves are interpreted, how duration and convexity measure interest rate sensitivity, and how credit risk and credit spreads affect bond returns. Let's begin with the foundation. Why bond prices and yields move in opposite directions. The most important rule in bond pricing is that bond prices and yields move in opposite directions. When the required yield rises, the price of a bond falls. When the required yield falls, the price of a bond rises. This happens because the yield is the discount rate. A higher discount rate makes future cash flows less valuable today. A lower discount rate makes future cash flows more valuable today. For a fixed-rate bond, the coupon payments are usually fixed by contract. The bond doesn't automatically increase its coupon just because market interest rates rise, so the price must adjust. If newly issued bonds offer higher yields, an older bond with lower coupon income becomes less attractive unless its price falls. If market yields fall, an older bond with a higher coupon becomes more attractive. This also explains par, discount, and premium bonds. If the coupon rate matches the required yield, the bond sells around par. If the coupon rate is below the required yield, the bond sells at a discount. If the coupon rate is above the required yield, the bond sells at a premium. But there is another important point. The price-yield relationship isn't a straight line. It is curved. That curvature is called convexity. So bond price changes aren't perfectly symmetric when yields rise or fall. This inverse and curved relationship is the foundation for understanding interest rate risk. Interest rate risk is the risk that a bond's value will change because market interest rates change. For a fixed-rate bond, rising interest rates usually reduce the current market price. Falling interest rates usually increase the current market price. The reason is the present value effect we just discussed. Interest rate risk depends heavily on timing. Cash flows that arrive far in the future are more sensitive to discount rate changes than cash flows arriving soon. So generally, longer maturity bonds have more interest rate risk. Lower coupon bonds also tend to have more interest rate risk because more of the bond's value is concentrated near maturity rather than paid earlier through coupons. There are two related components of interest rate risk. The first is price risk. This is the risk that the bond's market price falls when yields rise. The second is reinvestment risk. This is the risk that coupon payments or principal must be reinvested at lower rates than expected. These two risks matter differently depending on the investor's horizon. A short-term investor who may need to sell before maturity is especially concerned about price risk. A long-term investor who plans to reinvest coupon income must also think carefully about reinvestment risk. Interest rate risk is important not only for investors. It matters for banks, insurance companies, pension funds, corporate treasurers, and any organization that holds or issues fixed income securities. Now let's move to the yield curve. A yield curve shows the relationship between yields and maturities for bonds that are similar in major characteristics, such as credit quality, currency, and tax treatment. In simple terms, It shows how the market prices borrowing and lending over different time horizons. The term structure of interest rates is the broader relationship between interest rates and time to maturity. A yield curve is one way we observe that relationship. There are different types of yield curves. The Treasury curve is often used as a benchmark for default-free rates in a given currency. The spot curve shows yields on zero-coupon bonds across maturities. The forward curve shows rates implied today for borrowing or lending in future periods. Corporate yield curves show yields on corporate bonds, often separated by credit rating and maturity. The shape of the yield curve can tell us something about market expectations and risk premiums. An upward sloping curve may suggest that investors require compensation for longer maturities, expect higher future short-term rates, or both. A flat curve may suggest uncertainty or offsetting forces. An inverted curve may suggest expectations of lower future short-term rates, strong demand for longer maturities, or both. A humped curve suggests that pressures differ across maturity ranges. But we must be careful. A yield curve shouldn't be interpreted mechanically. The same shape can have more than one explanation. Spot rates and forward rates help us understand the yield curve more deeply. A spot rate is the yield for an investment that begins today and ends at a specific future maturity. In bond valuation, spot rates are especially important because each cash flow can be discounted using the rate that matches its timing. This is more precise than using a single yield for every cash flow, especially when the yield curve isn't flat. A cash flow arriving earlier and a cash flow arriving later don't necessarily face the same discount rate. The spot curve allows us to match each cash flow with the appropriate maturity rate. A forward rate is different. A forward rate is an interest rate agreed on today for a loan or investment that begins in the future. Forward rates are implied by today's spot rates and today's bond prices. But here is the key. Forward rates aren't guaranteed forecasts. They are break-even rates embedded in current market prices. They may reflect expected future short-term rates, but they may also include risk premiums, liquidity preferences, maturity preferences, and market supply and demand. So when we look at forward rates, we shouldn't say, this is exactly what the market knows will happen. Instead, we should say, this is the future rate implied by current prices, given the structure of the market. That distinction is essential for professional fixed income analysis. Now, we come to duration, one of the most important tools in fixed income risk management. Duration measures a bond's sensitivity to interest rate changes. It helps us estimate how much a bond price may change when yields change. The most basic version is Macaulay duration. Macaulay duration is the present value weighted average time to receive the bond's cash flows. In plain language, it tells us when, on average, the investor receives the economic value of the bond's cash flows after discounting. Macaulay duration is measured in years, but it isn't the same as maturity. A coupon bond can mature later than its duration because some cash flows are received before maturity. A zero coupon bond, however, receives all value at maturity, so its duration equals its maturity. Several patterns are important. Longer maturity usually increases duration. Lower coupon rates usually increase duration. Lower yield levels also tend to increase duration. These patterns make intuitive sense because duration rises when more value is tied to cash flows farther in the future. Modified duration takes Macaulay duration and converts it into a direct measure of price sensitivity. It gives us a practical approximation of how much the bond price changes for a change in yield. The key intuition is simple. Higher duration means higher interest rate sensitivity. Lower duration means lower interest rate sensitivity. Duration is powerful, but it is still an approximation. When we use modified duration, we are estimating the percentage change in a bond's price for a change in yield. The negative sign in the duration relationship reflects the inverse price-yield relationship. If yields rise, the estimated price change is negative. If yields fall, the estimated price change is positive. This is extremely useful for portfolio management. A bond portfolio manager can look at the duration of a portfolio and quickly understand its exposure to interest rate movements. A higher duration portfolio is more exposed to changing rates. A lower duration portfolio is less exposed. Duration works best for small yield changes, option-free bonds, and parallel shifts in the yield curve. In the real world, yield curve movements are often more complex. Short-term rates may move differently from long-term rates. Credit spreads may change even when benchmark interest rates do not. Liquidity conditions may change. Embedded options may alter expected cash flows. This is why duration is essential but not complete. It gives us a first approximation, not the full picture. A disciplined analyst uses duration as a starting point. Then the analyst asks, is the yield curve shift parallel? Is the bond option free? Are credit spreads stable? Is liquidity changing? Are cash flows still reliable? That broader thinking leads us naturally to convexity. Convexity measures the curvature of the bond price-yield relationship. Duration gives the slope of the price-yield curve at a particular point. Convexity explains how that slope changes as yields change. For most option-free bonds, the price-yield relationship is positively convex. This means that price gains from falling yields are larger than price losses from equal-sized yield increases starting from the same point. This is an attractive feature for bond investors. Positive convexity means the bond tends to benefit more when rates fall than it suffers when rates rise by the same amount. However, this statement applies most cleanly to option-free bonds. Bonds with embedded options such as callable bonds or mortgage-related securities can behave differently because their expected cash flows may change when rates move. Convexity becomes more important when yield changes are large, when maturity is long, when coupons are low, or when a portfolio has substantial exposure to long-dated cash flows. Why is duration alone not always enough? Because duration is like drawing a straight tangent line to a curved relationship. Near the starting point, the tangent line may be accurate. Farther away, the curve matters more. So in practice, duration gives the first-order effect, and convexity gives the second-order adjustment. Together, they provide a better understanding of interest rate sensitivity. Now let's turn to credit risk. Credit risk is the risk that a bond issuer may fail to make promised payments in full or on time, or that investors may require a higher yield because the issuer's credit quality has weakened. Credit risk is broader than default. Default risk is the possibility that the issuer misses a payment, restructures debt, or enters bankruptcy or similar proceedings. Downgrade risk is the risk that the issuer's credit quality is reassessed as weaker. Spread risk is the risk that investors demand more compensation for holding the bond. Recovery risk is the risk that after default, investors recover less than expected. Liquidity risk is the risk that the bond becomes difficult to sell at a fair price. Bond ratings are commonly used to summarize credit quality. They are opinions, not guarantees. Ratings reflect factors such as leverage, cash flow stability, profitability, liquidity, business risk, financial policy, industry conditions, collateral, covenants, and seniority in the capital structure. Investment-grade bonds are generally viewed as having stronger credit quality. High-yield or speculative-grade bonds carry materially higher credit risk. But rating labels are only a starting point. A professional investor asks deeper questions. Is the issuer's cash flow stable? Is debt rising? Is the business sensitive to economic weakness? Are covenants strong? Is the bond senior or subordinated? How much might investors recover if default occurs? Credit analysis is about understanding both the probability of trouble and the severity of loss if trouble occurs. Finally, let's connect interest rate risk and credit risk. A credit spread is the extra yield investors require to hold a risky bond instead of a comparable default-free bond. The spread compensates investors for risks such as default, downgrade, recovery uncertainty, liquidity, taxes, capital requirements, and changes in market risk appetite. When credit spreads widen, risky bond prices usually fall. When credit spreads narrow, risky bond prices usually rise. The price impact of a spread change is similar to the impact of an interest rate change because both affect the required yield. For a fixed-rate corporate bond, total yield changes can often be thought of as coming from two sources: changes in benchmark interest rates, and changes in credit spreads. That is why corporate bond returns can behave differently from government bond returns. Sometimes benchmark yields rise because the economy is strong, while credit spreads narrow because default concerns decline. At other times, benchmark yields fall because investors seek safety, while credit spreads widen because risky issuers look more vulnerable. So a lower quality corporate bond may not benefit from falling Treasury yields, its spread widening is large enough. This is why fixed income analysis separates sources of return. Coupon income, price change from rates, price change from spreads, roll down, liquidity, rating changes, and credit events. The common mistake is to look only at yield. A higher yield isn't automatically better. It may simply mean higher duration risk, higher credit risk, lower liquidity, or more exposure to adverse scenarios. The disciplined approach is to identify the cash flows, choose the appropriate discount rates, measure sensitivity to rates and spreads, evaluate credit quality, and decide whether the expected compensation is adequate for the risk. Thank you for joining me today. I hope this lecture helped you understand how bond prices, interest rates, yield curves, duration, convexity, and credit risk fit together.